This conversation, there's things that are actually at stake, large bases of capital that we're going to be talking about in this field.
We could probably argue whether this is a bull market or not, but I think for those building in this space, I don't know, I would think about it almost as like an adoption market.
I think there's two different problems in the industry when it comes to regulation. So,
welcome back to The Roll-Up, your home for technical talks and open conversations that shape the modular future. Nothing on today's show is to be construed as financial advice. You can see our full disclosures list at therollup.co/ventures. Sit back, relax, and enjoy today's episode after a quick word from some of our awesome partners.
Redstone is DeFi's modular oracle, supporting over 100 clients on over 50 chains and offering 1,000 assets. Redstone is the leader for Bitcoin staking and yield-bearing assets. They offer the most robust, customizable price feeds available in any model. Join the Redstone exhibition today. What is going on, guys? Welcome back to the Roll-Up. Super stoked to be here. Today we're recording on Valentine's Day with our Valentine tokenized securities. We're here with Carlos and Robinson. Robinson's a friend of the show. You've been on before. Carlos, it's your first time. Thank you so much for coming on to talk about something that I'm particularly excited to chat about, because a lot of times in crypto, we get into these very technical conversations, and a lot of times it's like we're fighting over like 10 users or 100 users. This conversation, there's things that are actually at stake, large bases of capital that we're going to be talking about in this field. Carlos, thank you so much for coming on from Securitize.
Sure. Thanks for having me.
Absolutely. Robinson, welcome back. Carlos, maybe we can start with you and, tell us a little bit about yourself. It's your first time on the show. Introduce yourself. How did you end up getting into this space?
Sure. My name is Carlos Domingo. I'm the co-founder and CEO of Securitize. I started the company in late 2017 on the back of one of the first tokenization projects in the space. So we've been very bullish about tokenization for many, many years. It's great that it's now kind of happening at scale in the industry. Started the company in 2018 with the aim of basically what people now call real world assets. That terminology didn't exist back then. It was basically about how you take tokens that represent, for the most part, securities that represent an asset that has some intrinsic value, whether it's a physical asset that has been securitized or it's a fund or equity in a company, etc. And then you put it on chain to make it more useful than the analog version, if you want. And over the years, this has evolved also on how it interacts with the rest of the crypto ecosystem, like DeFi and other things that didn't really exist, or stable coins. That those things, when I started in the industry, they didn't exist. They were like very, very small, so they were not really relevant.
Awesome. Yeah, I mean, going back to 2018, this was always the vision, was that we're going to tokenize everything. We're going to tokenize the world. Guys like Robinson have been working and have had a lot of conviction in this vision for a long, long time, because the natural fallout is connecting these blockchains so that we have a unified experience. But there's two sides to this battle. We got to get everything on chain, and we also have to connect all these chains together. And so it's no coincidence you guys are here together. Carlos, you and Securitize have been working with some very notable partners. BlackRock, among many others, in this BUIDL fund. I'd love to talk about what exactly this fund is meant to do. This tokenized real world asset pool of capital that has done such a great job in tokenizing a lot of assets. Maybe you could speak to some current metrics. How big is this pool of capital now, and why is it on chain?
Sure. So if you think about what so far has been the most successful tokenized asset, is probably the dollar, right? So if you look at stable coins, they are like around $200 billion now, and there's a proliferation of stable coin projects that essentially is a tokenized dollar. It's a token that represents a dollar that is kept in some reserve to guarantee that the token has the underlying value of the dollar. So if you look at traditional finance, people don't actually use dollars necessarily to move money around. They use treasuries, because treasuries, their obligations to the US government, which is also the one that issues the dollar. So essentially they are kind of like equivalent from a risk perspective, but they have a yield because they are a debt obligation, right? So treasuries give you a yield, which at this point is like around 4.5%, but was higher a few months ago. And therefore, the natural next large asset that should be tokenized are treasuries, right? So that's the project we're doing with BlackRock. is a tokenized treasuries fund that contains short-term dated treasuries and repo agreements, and that gives the yield in a transparent way back to the investor in the product and the holder of the token. Of course, as opposed to stable coins, these tokens, because they represent units in a fund, they are securities, so they have different characteristics. They are permissions, so we have to white these wallets, we have to onboard investors and pass through KYB to make sure we comply with regulations. We have to control how they transfer on chain, and when we issue them in multiple chains, we also have to control how they move across chains, as opposed to, let's say, digital assets that maybe don't have those characteristics. They are permissionless. You don't need to control who holds them, etc. So in terms of metrics, so the fund started in March last year, so it's still not even 1 year old. It grew very quickly to become the fastest growing and the largest tokenized treasury fund in the first few months of existence, and that the whole space has exploded since then. There's the last time I looked, there were like 44 projects or so trying to do similar things. Some of them in collaboration with us, building, kind of wrappers. Some of them trying to build their own stuff. Some of them from crypto native companies, and some of them from traditional asset managers that are basically essentially doing the same and trying to compete for the same space. So it's very interesting to see how it has grown from being very small to be, I think it's over $4 billion now in size, the entire space, which we are 650 million of that.
It's incredible. Absolutely stable coins, and now we're diving deeper into this real world asset base. This is one of the few things in crypto that has found product market fit at this level and at this scale. Robinson, maybe you could speak to the interoperability of this. It's one thing to tokenize these treasuries, ultimately unlock this capital base and make it programmable in the sense that, now we can collateralize these treasuries, we can stake them, we can do all kinds of creative things now that these are on chain. How important is interoperability in this case?
Yeah, absolutely. And maybe one thing I'll say is taking a step back, and this is something I also appreciate, about working with Securitize and Carlos in particular, is like studied conviction. The Securitize has been really focused on this particular market for a long time before it had a lot of adoption, before it became a narrative or anything like that. And I think what's really great to see now is it's really picking up steam, and they're right at the center of it is very much so the experts. And then similarly to Wormhole, when we first started, multi-chain wasn't the consensus. Like, there was a strong consensus that everything actually could be built on Ethereum. And there was a real question about our model, or like what we were doing. Because it was like, are we going to actually need this? Because, everything could be on Ethereum. And so I just think there's like a uniqueness to like this conviction that both of these, I guess, partners have that I like. And I think what we're seeing now, fast forward, many years, is when you talk to any of these institutions, and they can be of various types, a lot of them right now, fund managers bringing various assets on chain, they think on chain as like, ideally it's across as many chains as possible, right? Like, the end goal is you want access to as much liquidity and as many users as possible. And on chain, I think a lot of maybe blockchains, rightfully so, like we'll say it as referencing their chain. But I think the way we look at it, and I think and we're trying to meet the customer, and in this sense, the fund manager, is like making on-chain mean on all of the blockchains. Like, you're breaking down these liquidity silos, you're giving them access to all of the users, et cetera, which is how it should be. But unfortunately, with the nature of how a lot of cryptos progressed, it isn't necessarily. So with interoperability, you can kind of have your cake and eat it too, right? Like, depending on either how many chains Securitize is live on, Wormhole can help connect those, or just interoperability more broadly. And so there's been this really unique product market fit that's happened, where it's like, hey, I want to be on chain, not like on all the chains, not on one specific chain. And we help solve that.
I just want to add something to this, which is related to the history of the company. We started our first tokenization project, as I mentioned, started in 2017. And the oldest ones we have in the platform, some of them still active today, were around that time, 2017, 2018. And there was no debate. Everybody will do it on Ethereum, right? Like, there was not even a question of where to do it. But then, over the years, like, people started, coming up with new blockchains that started becoming relevant. etc. So the first step we took was, okay, so for us, a blockchain at the end of the day is a ledger, right? It's a better ledger because it's a public ledger that is cryptographically secure, that has is designed for recording and transfer ownership of an asset, which is what you actually need for securities. So initially what we were is like plugged on top of Ethereum. We were like tied to the hip to Ethereum. We couldn't do anything without Ethereum. And then in 2019, we did like a big re-engineering project to create like an abstraction layer where all our platform, is like a massive web platform with a lot of functionality, when it has to either issue a share or record a change on the share of ownership or pay a dividend or something like that, we'll talk to the blockchain through this abstraction layer. So that was the first step. And the second step was, well, now let's connect to other chains. And we did, projects with Avalanche and with Polygon, etc. And it hasn't been only until recently, but we're looking at blockchains as silos. Like we will issue this asset. Like we remember we did the KKR project with Avalanche on Avalanche, and they will only live there. Or, Hamilton Lane with Polygon, we did it only on Polygon. So really it has been more recently when we launched BUIDL, and BUIDL went multi-chain a few months after launching initially on Ethereum, that we were facing the problem of, well, now we have the same asset in multiple chains. So what happens if somebody wants to move it in and out because, you want to, interact with this protocol that it's there but not here, etc. And that's how the relationship with Wormhole started, to be able to facilitate doing that. So, and now we have the second asset, multi-chain, which is the Apollo Credit Fund. And I think moving forward, most of our assets will be multi-chain, because now this is part of our infrastructure to be able to issue across chains and being able to move the asset in and out.
Absolutely. This is the way the world is trending. Like, and I Robinson, I like the way you put it, where, when we're talking on chain, we mean on all the chains. And originally that just meant Ethereum. If you were on Ethereum, you had basically coverage over all the liquidity in the users. But now this liquidity user base has proliferated onto alternative layer ones, layer twos, etc. And so on-chain really means the vast coverage of all of that state, all of those liquidity and users. Carlos, I think this would be a good opportunity to unpack more of Securitize's architecture. You mentioned an abstraction layer that lets you communicate with the blockchain. Are you guys building out your own chain? Do you have nodes in a network? Like what is the system design here that lets you orchestrate these tokenization protocols?
We don't have our own blockchain, even though, like, as you can see these days, everybody that has an app with users and assets is kind of looking at that idea. We do run nodes for all the blockchains that we operate, because that's how you can guarantee the transaction, throughput and finality, and we can control how the assets are issued there. So we do run infrastructure for all the blockchains that we connect with. And as I mentioned, we have this abstraction layer that basically allow us to use one particular blockchain as a ledger, but we keep the record of who holds what, right? And then wallets have balances, and then off-chain, what we keep is the actual personal identifiable information of the wallet owner, which is obviously something you don't want to put on chain, not to disclose the identity of people. And on chain, we only keep the non-personal identifiable information that for compliance purposes is good enough, right? Like, have you passed KYC or not? Which jurisdiction is the investor in? From regulatory purposes, you need to know, like, are you an affiliate and we need to lock that token, or and do you have a certain lockup period, or with whom you can transact, etc. So that information, which is the rule base that the smart contracts manage, is kept on chain, and everything else is kept off chain. And off chain, we actually operate, the regulated entities, right? So these are like a transfer agent that use the blockchain as a ledger, the broker dealer that kind of sells and trades those securities. But we have like a full-fledged like brokerage account type thing, if you want. So if you're an investor in any securitized product, you will have created an account with us. That account passes KYC or KYB. You see your balances there. We have cash accounts where you can deposit cash or stable coins. You see the products that you qualify to invest, to be able to invest and get your tokens. You can connect wallets, etc. So that's kind of like the overall architecture of the platform. And now we have the Wormhole messaging system to be able to move the share class from blockchain A to blockchain B in a very efficient way.
Robinson, anything to add there in terms of the architecture and the way that tokenization has kind of proliferated across multiple chains as Securitize goes? And accrues more and more deposits, they obviously spread out to the liquidity and the users as that demand becomes available. How have you seen this architecture evolve from 2018, 2019 into more of a multi-chain world?
Yeah, that's a good question. I would say maybe one of the things that I'm excited about in particular is like the different type of securities that are being brought on chain. And then the other thing I'd probably say I'm excited about is starting to see them used in DeFi more. So what I think we're seeing, and this is particularly with Securitize, is like the various funds be actually used as collateral. And I think one of the leading ones actually is BUIDL, and Carlos can correct me if I'm wrong, but like it's a really, really good source of collateral. And there's a lot of whether it's stable coins like USDE or maybe DAI or now USDS, like that need some sort of collateral backing. BUIDL becomes this really good collateral that you can use in DeFi. And I think we're quickly going from institutions are coming in like 2017, 2021. It was kind of like this promise of like the institutions are coming. And I actually remember when Carlos sent me the Block Explorer link for BUIDL actually going cross chain. And it was one of those moments. It was like, wow, they're actually here. And we went from that moment, which wasn't too long ago, at least not tokenized on chain, but moving cross chain. I believe, the BUIDL tokenized on chain wasn't that much like longer before that, to now quickly seeing a lot of it being used in DeFi. So that the actual time to adoption is shrinking really fast, which I think is a really cool observation. And then, so I'm excited to see more usage in DeFi. And I actually, track it semi closely. And I know there's a lot of proposals out there, and Carlos can probably get more into that. The other thing I'm interested in is like the tokenization of different securities. Private credit, for instance, right? There's a lot of promises of tokenization. I think one of them is, access to maybe securities and things that most investors maybe didn't have access to before. I think that's a little bit more of a progression, like what sort of KYC, KYB you will need to have access to these things. But I think private credit's a really good example of something that's, historically been reserved for maybe more of like your higher net worth individuals. And there is a path to potentially where these private credit on-chain assets can be accessible to, people on chain, and people that maybe, have certain credentials, but maybe not the ones required to invest through a Morgan Stanley and then get access to, whatever sort of like private credit fund that they have. So I'm actually interested in number one, the adoption in DeFi, and I think we're seeing that proliferate. And then number two, the different things that get tokenized. And the one thing I'll say, and I think Carlos brought up a really good idea or a really good point, is when you think about like tokenizing something on chain, you can have it on Solana, but let's say you want to use that in DeFi and actually, maybe it's collateral on Athena. Like that's where the interoperability really comes in, where you're able to actually send that position you have on Solana, then you can send it to Athena. Athena, unfortunately, today only exists on mainnet, I believe. Take a position in that particular protocol. And this goes for all the protocols that, are on the chains where Securitize is tokenizing assets.
Yeah, I want to emphasize a bit on what Robinson mentioned about like private credit, which you just launched on with Apollo. We had a previous fund with Hamilton Lane before, and Hamilton Lane is only on Polygon, but the Apollo one has launched multi-chain with Wormhole powering the cross-chain interoperability. These are like, if you want to buy a private credit fund today, as a normal individual, you have to have an account with a wirehouse. That would be the case. So you have to have an account with JP Morgan or Morgan Stanley. So that's the number one, the first friction point, right? Like not everybody can get an account open with those banks, right? You have to have, a certain amount of capital for a wealth management account in those platforms to be open. And then the second part is that even when you're there, unless you have a certain amount of money, you don't even have access to the products, because the minimum investments usually are like $500,000 or more, because the whole process of investing is very manual, right? If you go to one of these platforms, I have accounts in some of these warehouses, you actually don't see anything. Like you don't even know what you can do there. Like you only see the positions of something you purchase. If you want to purchase something, you have to send an email to your wealth manager. If you are like under a certain amount of millions of dollars, good luck getting an answer, because they don't care about you. and then the minimum investments are pretty high. So for you to kind of diversify into private credit, with $500,000 means you have to have many, many millions of dollars, because otherwise it's not a good investment decision, right? So, and one of the reasons it happens, obviously there's regulatory reasons in terms of how those products are offered to individual investors. But look, accredited investors is like 17 million people in the US, and that don't even have access to those products. And you might be an accredited investor and have, $200,000 to $300,000. That doesn't mean you can actually spend $500,000 on a product, right? So being able to provide a good digital experience to access those products with minimum investments has to be enabled through digitization. And tokenization at the end of the day is a digitization process that enables this efficient fractional ownership. So that's the first one. And most of the products, except for BUIDL, which is for institutions only, but the rest of the products we have in the platform tend to have minimums of like $10,000, $50,000, etc. That's the number one aspect of it. But the second one is the utility of the product, right? Like you buy a credit fund and it sits there. There's nothing you can do with it. Sometimes you cannot even borrow against it because these are alternative assets that they don't know how to necessarily want to, lend you against it. And it will only be seen by the bank, right? Like if you buy it in JP Morgan, you want to take a loan against it. It has to be JP Morgan that gives you a loan, right? Once you put it on chain, you can take a loan from anybody that will give you a loan, right? Like there's now, for instance, we can create synthetic dollars with Scope, which is a credit fund as collateral through Elixir protocol, and then Elixir will give you a synthetic dollar that then you can stake and get a higher yield from it. That's essentially you're taking a loan against the asset. So I think that it not only gives you like a more efficient ledger that allows you to provide better fractional ownership, but it also gives more utility to the asset. And I think that's the key to unlock the power of RWAs, right? The compositability, how they interact with protocols, how you can create lending pools or more liquidity through automated market making, etc. And that's still in its infancy because there's a bit of a friction between the two worlds, right? Like the DeFi world is purely permissionless, anonymous, and the RWA world is permission and with known holders of the wallets, right? So bridging those two worlds is one of our priorities for 2025. And I think when that happens, which I'm pretty confident it will happen, you will see an explosion of adoption.
And is this the main value proposition when you're speaking to BlackRock, JP Morgan, Morgan Stanley? Are you primarily speaking about the democratization of potential buyers of these products? Is it that I'm sure there's several value propositions that may be one of them, in addition to higher potential yields as a result of bringing these things on chain, making them composable with other products where you can again leverage them for greater collateralization, more loans. When you're in the room, in the meetings with these major institutions, how do those conversations go? Suppose we're a billion-dollar asset manager. How do you come to those conversations and ultimately propose this tokenization fund?
I think the conversation has evolved over the years, and since I'm probably one of the oldest persons in the industry, since compared to not age-wise, probably age-wise as well, but also since the company started. At the beginning, it was more about like an efficiency play, right? Like these guys know that the way they manage their securities and their ledgers, etc., is very inefficient. So they see this as a better ledger to provide efficiency and reduce cost, etc. And over time, it evolved in like, well, maybe that efficiency in the ledger can, and with a digital front end, can also provide this democratization and broader access to get more AUM on the products by tapping people that today are not purchasing these products. And I think today it has evolved also, and well, now crypto, because keep in mind, I started the company in 2018. At that time, crypto was like $150 billion. Like the entire stablecoin market was like $4 billion. Like the going after the crypto market was not a thing because it was like, they will laugh in your face. Now crypto has grown to whatever, 4 trillion. I don't know where we are anymore.
The whole story then was like blockchain, not Bitcoin. It was like, put away this cryptocurrency meme
play,
thing.
right? So it was more
use
about,
the technology.
this is a better ledger technology for me to manage my securities. Now it has evolved in, well, maybe this is a way to tap into this $4 trillion fast-growing market that has all these other tools and all these other yield opportunities that these assets can actually participate in, that will not only increase AUM, but it also increase the quality of the asset, because the on-chain version now is not just a more efficient one for the asset manager, it's actually a better one for the investor. And before it was not like that. So I think the conversation has evolved, and that has made it more interesting, right? Because it's an easier sell these days than it used to be. And this is why the industry started with a lot of people doing private blockchains and things like that, because it was purely about, I need a better database. Now it's not, I need a better database. I need to tap into this ecosystem that is $4 trillion, that has a lot of other like earning opportunities that my assets do not participate in. And that's a much better interesting, right? So like if you think about innovation in any field, there's always like two consequences of it, right? You make something more efficient, or you make new stuff that you couldn't do before, right? And historically, innovations that only make things more efficient are less impactful, because yes, you can cut costs, you can save money here or there, blah blah blah. But so be it, right? Like but an innovation that allows you to do something new that you couldn't do before. That's where the things that really take off, right? So if you think an iPhone is not a better phone, and that makes better phone calls, it's actually a phone that allows you to do a ton of other things you couldn't do with a Nokia before. And that's why the iPhone took off, and that's why the completely new industry started, right? As opposed to back then Nokia, Motorola, Ericsson coming up with a better phone that was cheaper, like high quality voice, because they need to put a new codec or whatever. So
I do miss my slide, my old Nokia slide. That was good tech. That was good.
My first one too.
You're not that old.
LG slide.
I always talk about telecommunications because that's where I worked for many years before I moved into crypto. So there's a lot of examples of things that happened there that are a good example. Messaging is another good example, because SMS had existed for a long time, right? So, but then things like WhatsApp, etc., it was not like just making more efficient messaging. Is what all doing the things you couldn't do before. You could actually like share pictures and group chats and share other stuff. And now they have like a ton of different
emojis,
things you can
stickers.
You can stickers. You can create polls, and there's so many things that you can do that you couldn't do when you were trapped into the old technological framework of the SMS network infrastructure. So
a lot of this is a social framework too, right? Like we had a little bit of a glimpse in this into 2017, 2018. And then again, after the big run up in 2021, we saw a little bit in 22, where like these companies that had previously they weren't really like allowed socially. It was not okay for them to touch blockchain or cryptocurrency. They started taking a look. We had brands like Starbucks, consumer brands, Starbucks, Coca-Cola, et cetera, kind of, allude to this. But, from a financial point of view, this again was like you couldn't touch it with a 10-foot pole. These things are evolving so much now. Like again, from the 2018s, 2017s to now, the companies and the institutions have evolved, and those conversations have evolved. But if we fast forward even now, just in most recent months, regulations have evolved, policies have evolved. The entire sentiment around the sector has shifted. How has that played into some of these conversations? Kind of, maybe we had Era 1 back in 2018, a lot of private blockchain technology and efficiency benefits, but not really tapping into the liquidity. Now, fast forward again, there's $4 trillion. Stable coins have product market fit. DeFi is real. There's a lot of liquidity and users here that these institutions like to tap into. Now it seems like we're in like 3.0 territory with regulation, with policy. Things are starting to adapt once again, starting to evolve once again. How, maybe now this is kind of more forward looking, how are you guys thinking and anticipating this will kind of take shape over the coming months and a couple of years? Innovating finance, global, institutional, and on-chain. Deep liquidity to drive capital efficiency. Now, maximize yields on institutional grade liquid staking with METH. Unlock $1 trillion of capital via Bitcoin. All of this secured by Mantle's treasury of billions in stables and ETH capital pools. This entire ecosystem is coordinated by a vast network of seasoned VCs that are aiming to create the next generation of banking and financial technology. This is Mantle.
Yeah, I think maybe I'll start. And we could probably argue whether this is a bull market or not, but I think for those building in this space, it's I don't know. I would think about it almost as like an adoption market.
More like a cow market.
What market?
Cow market. It's not
a market. Yeah, but what I would say is that I haven't had any more, I haven't seen more acceleration ever, at least in in Wormhole's era, around meaningful product adoption and speaking with companies that are actually driving things forward. And I think you brought up a good example, which is stablecoins, right? Like stablecoins have this product market fit. Everyone's realizing it. I think the US government's even realizing that, like, hey, this is actually kind of good for the foreign reserve currency status. And all of a sudden you're seeing this, acceleration across all these new issuance of new stablecoins, USDL, USDE, USDG, AUSD, M0. We could probably name a lot more. And I think what's interesting is a lot of it is in this theme of like assets being issued on chain. And then what's good for, obviously, for our business is like the number one thing that they care about is like, okay, when we say on chain, just going back to what we talked about at the beginning, I mean like all chains or as many chains where there's meaningful usage and liquidity as possible. So I think for us in particular, we've never been more, I would say, like busy around meaningful adoption, not only with on-chain protocols. That's what I think is maybe the biggest distinction, but like entities that haven't traditionally participated in the on-chain ecosystem that are figuring out how they can gain efficiencies from coming on-chain. And that, again, comes in the form of stablecoins, but a lot of it payments, right? Like I actually remember not too long ago, it was actually late last year. There was a bunch of folks in Singapore. Breakpoint was there, Token 2049, and the application, the Grab, I think it's called Grab. It's like their version of Uber. You could actually pay with stablecoins. My credit card had like one of those alerts where I was traveling too much and it like wouldn't let me pay. And I saw the option for stablecoins. Not only was it USDC, which I thought was interesting, it was also PYUSD. Like that's pretty quick adoption curve for PYUSD. And so, we're also working closely with them. But I just thought that was super interesting. It was like when you experience the tech in the wild, it's like that moment where you feel like, some validation about the industry you're in. And I think we'll see those experiences. We will definitely see those happen much more frequently.
If you want me, I can talk about regulation a little bit. So I think there's two different problems in the industry when it comes to regulation. So one is for let's say the non-RWA part of the market, like the digital assets, is like, how are you even being regulated? Or like, are you regulated by the SEC, by the CFTC? Yeah. Like, how the trading platforms get regulated. It's kind of fun. Like I heard like some exchanges say, "Oh, we're regulated." It's like, well, you're not really regulated. Regulated by whom? Like you don't even know how you need to operate, right? So that there's no clarity of regulation there in the sense that they're starting with a basic question of where my asset falls, is a commodity or is a security, and then second is how this asset actually trades when it is being properly categorized into a commodity or security, and who regulates the trading platforms. And if you think about traditional market structure, that it looks very, very different, right? Like in traditional market structures, you have Robinhood, which is a broker dealer that will connect to the New York Stock Exchange, that is a trading firm that will have a central security depository, which is the DTCC, and custodians are separated. Everything is segregated. While in crypto, everything is collapsed into one and single entity where you are the broker dealer, the trading platform, the market maker sometimes, and etc. So that's something that regulation needs to address and determine how it works to make sure that primarily there is no fraud, right? So this, at the end of the day, that's what regulators are concerned about. And on the RWA space, I think that the regulation is pretty clear, right? Like, as I mentioned, 99% of RWAs you can think of are securities, because you're either securitizing an asset or you're tokenizing an existing security, whether it's equity, a fund, or something like that. So the fact that this falls under the SEC is not questionable. I think what the problem has been is, well, if I am a broker dealer or a transfer agent and I use a different ledger technology, which happens to be a public distributed cryptographically secure ledger, do I need to be regulated differently or not? And it's kind of ironic that in the Gensler times, he used to tell the crypto people that complain about them, saying, well, you guys shouldn't be regulated differently because you use a different technology. Because they were trying to create like exemptions about how the assets work compared to, like, let's say, traditional assets like securities, like equities, etc. But then it will come to broker dealers like us or transfer agents and tell us, oh, you need to get a different license because you're using this different ledger technology. So my position there is like, I just want to use whatever ledger technology I want. And then the regulators shouldn't regulate by technology. They should regulate by making sure I adhere to customer protection rules, disclosures, like all the stuff that comes with the products that we offer, to make sure investors are protected. I don't lose their assets. I always know where they are. If they want to buy something, they know what they're buying, etc. And if I want to store them on a blockchain or another. That should be my problem. And as far as I comply with all the customer protection and rules, right? So hopefully this time things will be different. For two reasons. One is because they're now going to really seriously, take decisions on these things that have been undecided in the past, or at least uncertain. And second is because the attitude will change, right? Which I think is also an important thing. Like, look, people take their own views about how regulations apply or not. And then besides people purely doing fraud, that I think the SEC and everybody should continue going after those, because we don't want those people in the space. But the other people, they don't do things with bad intent. They just do because that's their interpretation of things. And then regulators shouldn't just go and sue them. They should just come and talk to them and then enter a dialogue. And if ultimately the regulator doesn't like what they do because they think it is infringing some regulation, that's fine. They should let them know to correct it. And then if not, then obviously use enforcement action to stop them from doing something they consider fraudulent, right? But don't start there. So start with a dialogue with people to give people a chance to explain themselves why they're doing something. This
is fundamentally a shift in mentality, in the sense that before it was just very closed-minded, right? Now we're very open-minded, and we're at least going to think about the opportunities to innovate. Whereas before it was, in the times of Gensler, it was regulating through enforcement, which was an unsustainable practice and also very closed-minded to any kind of innovation. Now it's just a complete paradigm shift. You have, not only do you have Doge and the government kind of just scrapping away all of these expenses, and, would they be easier to scrap away if they were on chain? Absolutely. So, when you hear,
they're easy to scrap away, they know what they are, right? Like, I don't like, again,
exactly.
A blockchain is just a better ledger, right?
Exactly.
They need a better ledger for sure, because they apparently don't even know where the money is or who's being paid and stuff like that. And they also probably need a ledger that it's shared across everybody, so everything gets consolidated in one place and it's easy to track, right? And yes, that could be a blockchain, but I don't know, sometimes everything gets fixed with a blockchain, right? Sometimes you just need like a proper tracking system, a database that doesn't seem to even exist in those places.
I was having this conversation the other day, it's just phenomenal if it ends up happening, but the shift from just paper in a vault to a blockchain is a gigantic leapfrog. You would think that we go from a paper to a database to digital to blockchain, but if we just go 0 to 4, by all means, let's do it. Now, when we're thinking, just even as a thought experiment in theory, if something like this were to happen, you guys right now are working with some of these major financial institutions to tokenize these treasuries. What if we go further up the stack? What if instead of the treasuries, getting auctioned off by the Treasury in order to, then get bought by some larger institutions and then ultimately end up in BlackRock and BlackRock tokenizes, what if we were to go further up the stack and just conduct, when the Treasury needs to finance the government, it issues these treasuries and then people buy them at auction? Could we just service that auction on chain? Is that technologically possible?
I think that those issues are not technical issues, right? They're more regulatory issues. So again, look, the technology is there. I think is compared to when I started in 2018, I think it's pretty mature at this point in time. So I don't see any use case today that the blocker is that the technology doesn't work. There's going to be something out there that works. It's more about regulations and about maybe integration with whatever system. I don't know what system they use, but I'm assuming the Treasury Department has some sort of ledger where they keep track of what treasuries they sell. Somewhere.
I'm not so sure, man.
Well, I don't know. I hope they do. Look, I hope they do, right? Because this is our taxpayer money that goes there. So, but so yes, this is doable. But I always say something that, look, you can solve two types of problems, right? You can solve, in innovation, they call it the red oceans or blue oceans. Red oceans is where you're lots of people trying to do the same thing. You have to displace maybe some existing infrastructure, and it just becomes like this insurmountable problem to solve. And sometimes it's better not to solve it. And a good example are mainframes. Like, you will think banks will get rid of mainframes. And if you look at IBM P&L, they still make a ton of money with mainframes because somebody has decided at some point it's just better to let that continue existing there and die, and then just maybe innovate on the digital experience of how you access the mainframe and a mobile app or things like that, right? So I do think that trying to put a blockchain everywhere is maybe not the best approach, and you have to do it in the places where there is less friction for adoption, because there's literally nothing being used today, and you're not displacing an existing system that might be extremely inefficient, but nevertheless works, right? And then, yes, you can show efficiencies by doing it using a blockchain, but displacing the existing systems and all the integrations and all the people, the touch points, etc., is very complicated. I remember several years ago, we did a project with a bank and a large system integrator. I can't mention who they are, but thought to put on a blockchain something called commercial paper. I don't know if you guys have heard of this. This is an asset class that is actually trillions of dollars, which are basically unsecured loans that really high quality companies issue to basically finance working capital. So you can get commercial paper from Apple and from companies like that. So this, if we did like a whole study, spend months in the bank, and then draw this diagram about all the systems that they were touching to be able to, from issuance, from say, okay, I want to issue $100 million in commercial paper, to like getting into the hands of the investors that were buying them, and all the intermediaries, all the systems that were communicating. And they had like, I don't know, a few percentage of reconciliations errors every time, because something was getting lost somewhere, or somebody was typing the wrong data somewhere, etc. So you could argue this is like a perfect example of having this on the same ledger, where the entire life cycle of how this security gets issued and purchased, it is tracked there and recorded there, is a much more efficient system. But the problem is, what do you do with all this infrastructure that moves trillions of dollars that is already there, right? So I think that's a big problem that maybe somebody will solve, but I think that is much easier to take those assets, forget about how they're being managed inefficiently today there, but take them and put them on a blockchain for interacting with the crypto system as a complete new ecosystem, where you don't have to worry about fixing the legacy stuff, but just take them and use them somewhere else in a more efficient way.
The legacy stuff, we call that tech debt.
Well, so yeah, not sure if it's tech debt or tech that was actually modern back in the days, but that you need to replace it, right?
Yeah. Robinson,
Calling all roll-up builders. Maybe there's an idea for someone to tackle.
I mean, ultimately, this is what's happening at a nationwide level, and it's not just our. It's like it's the entire world, right? Where this is why the IRS never passes an audit, for the same reasons that Carlos described. Is like there's too many tentacles in this system, that you end up like going further and further down the line, that you really lose track of where these things are. But at such a large scale, the things that you lose track of could still be millions, if not billions of dollars.
Yep.
So ultimately,
it's a record keeping problem, right? So if you think in traditional markets, another big problem is the short sellers that are shorting stock without actually having the actual stock, but because nobody can track who holds what. Nobody can actually know whether that's actually true, right? Like nobody knows how many, like if you're Apple, you publicly traded, you have no idea who holds your shares. There's no way for you. There's no like a ledger where you have the names of everybody that keep changing on a daily basis, and that doesn't exist, right? It's all like fragmented across all the broker dealers and all the OTC desks, and like so many people, and that creates problems, like not knowing how many outstanding shares are. There's like tons of examples in traditional finance about more shares out there than they have been authorized to issue, and problems of that nature, which you will think like, wow, this is if they had a ledger where they could keep a record of things. So I think it's the same with payments for the government, right? Like they just probably don't have a ledger not to know exactly how much they pay and to whom.
Yeah. And so we're suggesting that the blockchain would actually benefit this system incredibly, but implementing it is such a tall task that we shouldn't even try.
I don't know. I guess you should look at case by case, right? But because in some places where there's nothing, maybe if you need to start from scratch, as you said, maybe you just need to go out to the best technology available, which is a blockchain, right? And in some other cases, you might actually have, a bunch of like databases out there that are not properly connected, or people are maybe not recording the payments well. I don't know exactly what the problems are, right? So I will look at case by case, but it's not a simple problem when you're dealing with legacy infrastructure.
Yeah,
I can tell you that.
I mean, absolutely. And like this, I kind of facetiously called this tech debt, but if we look at like what the government is doing and treating the government like a company, they're going through not just tech debt, but also labor debt, in the sense that they have to lay off all of these people, getting rid of legacy systems or federal employees that have been there 20, 30, 50 years. That ultimately is part of that upgrade. It's part of that process to go from a legacy system that may have a lot of manpower and a lot of paper and a lot of technical debt towards a more efficient system means laying off people or upgrading systems. And kind of what do you do with the old stuff? Ideally, you recycle it, you make it something you can reuse, but sometimes you just do away with it.
I'll give you a good anecdote, because and I can't mention the companies, but one of the transfer agents, traditional transfer agents that we interact with, because sometimes we act as a transfer agent, sometimes others act, and so traditional fund admin and not transfer agent that we interact with. Actually, there's something called a super sheet, where you get actually the positions of the fund to be able to calculate dividend payouts and stuff like that. And then they actually use a fax. So this is like today's, and then because we don't have a fax in the office, we come up with like an email system where you can basically take an email and spreadsheet that arrives to like a fax, which I didn't even know that those things existed. I didn't even know that fax were being used today. So, but yeah, so the legacy is there, and it's been working for what they do for a long time, and sometimes nobody bothers to upgrade it because there's no immediate need or advantage. And then when you're faced with digital use cases like tokenization, that's when people wake up and say like, oh wow, my underlying systems are pretty outdated, and maybe I need to upgrade them to do something better.
And I think another interesting anecdote in like completely different sector, I spent a number of years at DoorDash, and I kind of believe sometimes our role was like modernizing restaurants. For instance, when we first started out, it was incredible to us how many restaurants were still on faxes as well. Like they would take orders, like call in orders or send in orders from the website or something like that. It would come in via fax, and then they would organize it. It was almost an uncomfortable amount. And a lot of our uphill battle was actually like designing systems around how for them to receive faxes efficiently, make sure the driver arrives on time. Like there's a lot of logistics to coordinate. And it actually we ended up pushing more and more into the business of like point of order sale. So like helping modernize the restaurant by bringing them on to like, more of you probably would, if you were ever to go in a restaurant, probably would see it more as like your iPad architecture right now, or like they have used to have multiple iPads. Now they've condensed them. But it was always crazy and funny to me how many will still use fax. So if that's like restaurants in the private sector, just imagine the public sector and all the entities within there.
It's so I think that is where some of these sectors, and Carlos, to your point, it's a case by case basis. Totally agree, because you start to get in these situations where like a restaurant, I got to believe they want to be as efficient as possible. They want to modernize. They want to upgrade. Okay. The government, I don't know if I can say the same. I think there is people in there that want to be more efficient. They want to cut spending where it's waste. They want, to streamline things. I think there's another angle where there's some intentional secrecy, keeping things discreet for the reason of making sure that some payments continue to get through, because if they were put on a public ledger, no one would ever approve of it, right? And so that's where I think some of these they get into a case-by-case basis. Some of them are easier to implement. Others take a little bit more social proving and social consensus in order to really rally a considerable change. Nevertheless, you guys are fighting the good fight on multiple fronts and in multiple sectors. I really appreciate you guys coming on. The fun fight, absolutely. It's a blast, and it's a wild ride. A lot of ups and downs and twists and turns. So, guys, thank you so much for coming on.
Of course. Thanks for having us.
us.
Appreciate it.
And congrats on the success so far. It's been amazing to watch.